Hey everybody, good morning to you. Time for Trading Futures. My name is Brent Moores, sitting in for Ben Watson this morning. I'm glad you've joined me, and I'm also glad to be joined by Barb Armstrong, who's helping me on the chat today. So I appreciate you. Today I really want to take more of a kind of a beginner's look at trading futures and give you some examples and just get you acclimated with trading futures so you're comfortable with going on your paper money and placing some practice trades on futures. So we'll do that. But first, let me just mention that on the you can always follow Barb or myself on X or any of the other coaches here. At Brent Moore CS, at Barb Armstrong CS are our handles. And we post additional content throughout the week. And so make sure you check that out. Now, before we get into the meat of the substance here, I do need to just remind everybody that futures and futures options trading involves substantial risk and is not suitable for all investors. And futures accounts are not protected by the SIPC. Futures margin is the amount of money you're required to deposit in your futures account to establish and maintain a futures position. Stock, ETF, and index options are not suitable for all investors, as a special risk inherent to options trading may expose investors to potentially rapid and substantial losses. You should carefully consider whether trading virtual currency derivatives is appropriate in light of your experiences. The information today is for general informational purposes only and should not be considered an individual recommendation or personalized investment advice. The paper money software application is provided for educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. And let's see, that I think we got one more. Okay, now here's a big thing with futures. Stop orders are not guaranteed in execution. We'll talk about that a little bit more as we go forward, because that is a difference between stocks and futures. There's some subtle differences there, but important differences. Investing involves risk, including for some products more than your initial investment. Okay, let's head on over to the thinkorswim platform. If you want to see what futures are available, there's a couple different ways on futures to see this on futures. One is you can pull up a watch list. If you go to watch list, I have a watch list here, gadget on the left. You just click on the little plus sign to get the gadget. Go to public watch list, you'll see one that says futures. There's also one that shows micro futures. We'll talk about the differences there on those in a minute. However, you can also just go up to the ticker symbol right there, go to the little drop-down menu and click on the futures tab, and that's going to give you a list of a lot of different futures. Now, there's a variety of different futures out there, everybody. And so that's one of the benefits. There's pros and cons to futures, but there's a variety of different futures, types of futures that you can trade. Here are some examples of them. You guys have heard of, maybe you go back to, what was the movie, Trading Places, where they're trading agricultural futures, hog futures, cattle futures, pork bellies, I think is them. So agricultural futures, grains, livestock, food and fiber. Each of these contracts, though, have different specifications. In other words, there's different numbers of amounts of corn that are going to be in a futures contract versus oats. Or if you look at energy, this is kind of a more common type future that people look at. Crude oil, West Texas Intermediate Crude. That contract /CL is a very popular one. That's not a recommendation. I'm just saying it's a popular one. Has a different amount in the futures contract than, say, gasoline futures. There's financial futures, interest rate futures. Maybe we'll take a look at those a little bit today. But do you see how you can look at these things? Currency futures. and indice futures. So very often people will use things like the S&P 500 future to help hedge a portfolio. A lot of different varieties of futures contracts, and that's kind of a cool thing because, sometimes maybe you don't want to trade an individual stock. You want to go, hey, I want to speculate on the price of oil or gas or something else. You can do it with futures contracts, or interest rates is an example there. So just realize there's a big variety, and you can see that variety when you go on your thinkorswim desktop software. Click right up here, and you can see right up here, okay? And just kind of scroll through those. Now, you do need to be careful with futures, just like if you're an options trader. I always pound on you in my webcasts, and Barb talks about it as well in her webcast with options. Make sure you're careful about the liquidity of these contracts. So if you're clicking on something, say live cattle futures, and I pull that up and I go to the trade tab, when you pull it up, you can see there's different futures contracts. One will be highlighted there typically, okay, if you're showing all of them, and that's going to be the active contract. There's a volume column. Just take a look at the volume when you're looking at futures. Some futures have a lot of volume. Let's take a look at gold here. Here's gold futures, 288,000 contracts there on that one. Whereas if I go to something different, here's emerging markets. Is that going to come up? That's not going to come up. Let's try palladium futures. 5,900. That's actually not terrible, but you can get some. I think like if we do rough rice, we'll probably get fewer. Yeah, only 53 futures contracts out there. So as much as you want to trade rough rice futures, and as much as the chart may look attractive to you, just be aware of that. Today, what we're going to do is we're going to stick with some of the more common futures out there, and let's start with crude oil futures. And you can see a lot of volume on crude oil. Let me pull up a chart of crude oil. There's crude oil. It's been kind of declining here a little bit. And one of the things with futures is you can do technical analysis on charts for futures, just as you can individual stocks here. And that's a basis for a lot of traders. It may not be your sole means of investment research, but it is an important part for a lot of traders is to do your technical analysis. You can still look at trend. You can still look at support and resistance levels. You can still use technical indicators here. But when you're dealing with futures contracts, what I'd encourage you to do is you need to be aware of how much movement you're going to have, because there's a lot of leverage with futures contracts. If you click on the Analyze tab, and I just have crude oil futures here as an example, you're going to see an area here where it says minimum tick, tick value, and multiplier. It's important that you understand this. We're going to start with one that is going to seem very basic, but it gets more complicated on some. Let's start with that minimum tick value, 0.01. So if that makes it easy. This can go from 58.36 to 58.37 to 58.39 and so on. This last, we can go to 2 decimal points. We're used to this, when we're dealing with currency transactions. But notice this, it says tick value. Each tick, so each 0.01 move, 58.42 to 58.43, it can happen very quickly. I mean, we're already down 110 ticks today on this, okay? We're down 110 ticks on this today. Each tick is $10. That means if I took 110 ticks times the $10, that's over $1,000 move on crude oil today alone. So that's a lot of money. Now, you can go through the math on this, and I think it's important to understand the fundamentals of this. but you can also use the multiplier as an aid for you. 1,000. That means every full dollar move on this, okay, from 58.36 dollars a barrel. That's what we're talking about here on crude oil, $58.37 a barrel, to $59.30, it's moving a little bit, cents a barrel, is $1,000. That's a lot, right? I mean, if we think about this, when we're looking at this and we say it's $1,000 per full point move, and we went on this day down from 61 to 58, that's a $3,000 move on that. So when people caution you about futures contracts, one of the reasons is just the leverage of the contract. That's a big move. Let's do this. And you can look micro futures. You can go here, and these are also going to be listed down here under the futures watch list. They have an M in front of them typically here. And if you click on micro crude futures, you can also see it here under the specific list, micro futures. Now let's look at the difference here on this. If I go to the Analyze tab on this, notice what happens. Minimum tick, 0.01. That's the same as what we were talking about. Tick value. Oh, look, it's no longer, remember when we were looking at, in fact, let me just compare the two here real quick. When we were looking at crude oil, minimum tick 0.01, tick value a full $10. Now with the micro future, the tick value is $1, 1/10 of the amount. The multiplier is 100. So if I go from 58.33 to 59.33, a full dollar, that's a $100 move, not a $1,000 move. When we look at the chart's going to look very similar. $3 move down a couple days ago. Okay, that was Friday. $3 move down. Well, $3 times 100 is a $300 move, not a $3,000 move. Now, just keep in mind, with futures, you need to be approved for futures trading. Okay, you can't just go out and trade futures. You need to be approved for it. So you can do that through your broker. And so that's kind of the basics of that. But let me show you something kind of different here, because that example was probably pretty straightforward. But if I go to, say, heating oil futures, look at the minimum tick on this. It's not 0.01. It's 0.0001. There's your tick value, $4.20. The math gets a little more complicated on this. Now, multiplier, $42,000. Now that may sound like a lot, and that is a lot, but keep in mind, heating oil is at $2.19. A full dollar move on heating oil would be a very, very big move on heating oil. You can kind of see the scale on that, hence the $42,000 point value on that. So just, be aware of that. Now, if I go to, say, let me go to, let's see, I want to go to NASDAQ futures, NQ. Where's NQ? There's NQ. Notice the tick size, a quarter, okay? They're a quarter, 0.25, a quarter of a point. So when you're looking at these NASDAQ futures, and look at the value up here. Notice it's not going to go to 0.26 or 0.28 or anything. It's going to jump in a full 25-cent increment, okay? Now, how do we trade them? You can buy futures, which means you go long the future. You can go short the future as well if you want. Let's take an example here. Let's go to one that's a pretty common one that people are often interested in. Again, not a recommendation, This is the micro gold futures. You can see the values up here. I just have them up on the chart here. The chart label, by the way, is in the description for this webcast. And for those of you watching live and are in the chat, what I'm going to do is I'm just going to share that label with you if you like. Let me just write this down, futures label. We're going to share that. I'm going to put this in the chat. Just remember, scripts aren't guaranteed for accuracy or timing here. Those of you watching live, there it is. Those of you watching on a recording, it's in the description for the webcast here. Okay, and that makes it easy when you have that label on there because you can see it right there. Point value is $10. So if I'm looking at this and going, well, you know, what if this chart, let me just zoom in just a little bit here. Let's say we continue our way up. I mean, we were at $3,900. Could we see it going to $4,300? I mean, given what we've seen in terms of the hundreds and hundreds of dollar move, it doesn't seem unreasonable. How much of a gain would it be? Well, point value or the multiplier is $10. $10. So the difference between 4,300 and 4,140, 4,300 minus 4,140 is $160 times 10 is $1,600 if we went up to $4,300. That's what the gain would be on that. You can also consider it as a loss. Let's say we were to do a stop on this, okay? Now, I'll talk about stop losses in just a sec on futures. Let's say we went below these lows here, and we went down and we put a stop here, and let's say, for example, we got stopped out right where the stop was. I would take my entry price, which is 4137.9, okay, minus, it's moving around, 3967.7, that's a $170 move down times my point value. That's a $1,700 loss I would be incurring on that if I got stopped out there. Now, the thing with futures and stops is this. When we have stocks, and we're talking stocks, and we say, hey, there's a stop loss, there's what happens is if the stop loss gets hit, it turns into a market order. And then, of course, market orders, we don't know what price exactly it's going to get filled at. You just never know. There's a complicating factor with futures called protection points. And that means that even if the stop is hit, there's not a guarantee it's going to fill on that. There's no guarantee it's going to fill because there's a protection point value for each specific futures product, and each product is different. But what happens is when the stop order is triggered, it becomes a market order. However, with protection points, the order is only allowed to execute at a certain price. Effectively, it comes like a limit order. And therefore, there's no guarantee it's going to fill. If I have a stock with a stop order and it goes down, that stop, it will fill at some point. We don't know what price will be, of course, but it will fill. With futures, there's no guarantee of that. So just be aware of that. If there's a big move in that future, that's the danger on that. But you can still put in stop orders on these. Just need to be aware of that. So if I wanted to go long, in other words, I wanted to go bullish on this, I would buy it. So if somebody says they're going long micro gold futures, long means we're going to buy it up front, okay? And that's bullish. If I'm going to go short, that means we're going to sell it up front, and that's going to be a bearish trade on that. That's bearish, okay? This is an important thing. So it gives you a lot of versatility of trading. We kind of often get in this bullish mode here, but just realize, hey, you can be bullish or bearish on this. Now, with gold, you can do trades shorter term. You can do trades longer term with futures. I think I don't probably need to explain to you how much gold has come up over the last, quite a while. Here's the 3-year chart on gold. I mean, gold was down at $1,600 3 years ago. $316 a troy ounce 3 years ago. We're now at 4,100 and change. That's a big move. How much farther is this going to go? I don't know is the answer. Is this the very top? It could be, is the answer. However, if you were a trend trader and you're going to take the assumption that, hey, I want to participate in this gold rally, and I think it's going to continue to go up, we could do that trade. I am going to put a stop loss on this in our example trade, and I'm going to put the stop loss just a little bit below the recent support. I'm going to call this a little support level where we came down, kind of a flaggy pattern almost right there. And I'm going to go a little bit below that, and we'll go to 39.36. Okay, let me just jot that down so I don't forget it. 39.36. I'm just going a little bit below where we'd be expecting the bounce perhaps on this. Okay, so if I want to go long, how can I do that? Well, I can go to the trade tab if I want. Here it is. There's the future, and I can either click on the contract, but first, before I do so, I want to double check the volume. 530,000 shares. That's a lot of 530,000 contracts. That's a lot of contracts out there. But what you can do is you can also, and I can right click on this and I can buy this. I can buy custom with a stop. I can do the same thing, by the way, on the chart. I can right click. I can buy custom with the stop. It's going to give me 2 lines. Let me just get rid of this left-hand column. Here's the futures contract. Just double check the quantity. We're going to do 1 contract for our purposes here today. You should be able to move that out so you can see those. So we've got 1 contract, and here's my price. Let's see if we can get to see the full price there. It's a limit order to buy, meaning this is the most I want to buy it for, and we can move this up if we want. And here's our stop order. Well, I'm going to make our stop good till canceled. That's pretty similar to a stock. Our stop, we said, and I jotted it down because I knew I was going to forget, 39.36. 39.36. Okay, and stop is good till canceled. And as I discussed earlier, not only is the stop price not guaranteed, that stop itself is not guaranteed to get us out on that. Okay. And there's a question in the chat. I will get to that question in terms of what contract would we do here? Why would someone choose a different contract? What I'm going to say to you as a beginning contract trader, a beginning futures trader, is generally we're going to go with the more active contract, the one with the more volume there on that. If now let's think about futures in a sec. Let's say you actually you want to use this as a longer term trade, and you just want to stay in the contract and you don't want to roll any contracts. You could choose a longer term contracts there. Okay. So let's go, but generally you're going to trade the contracts with more liquidity. It's going to help you with the price, the pricing in terms of less slippage, a tighter bid-ask spread on these type things. So we've got the stop. We're buying. I'm going to go and say, look, I'm willing to buy. I want to get in 41.30. I'm going to put in 41.35, and I'm going to confirm and send. And I'm just going to review everything here on this. And I'm going to send the order once I've done that. And there we go. So we have the order in. The prices move. We're kind of right there. And so hasn't filled yet, but we'll see on that. There we go. It just filled on us there. Okay. So once you have, now question in the chat, I gave you the futures label. You know how to do that. How do you load it? What you do is you take the URL that we put in the chat or that's in the description and go up to the gear in the upper right portion of the page. And you just got to be careful. There's more than one gear on the chart. Look, there's a gear there, there's a gear there, there's a gear here. You click on the chart and you go to open shared item. Okay. And you paste it right there. You just need everything from the exclamation point on. Then you click on preview. You can title it whatever you want to title it, and then you click on import. Once you have it imported, this is a study. So you would add it just like you add a moving average study, except it will be under the name, whatever you've named it. I've just named it futures chart tick value here, but you can name it whatever you want, whatever you're going to name it. So that's a long trade. That's a bullish trade. This is a speculation that the price of gold is going to continue to go up. We did a micro futures just to try and deleverage it a little bit from the underlying, but the underlying price of gold, but that's how you do it. Now, Kevin says each dollar move in this is $10 here, okay? This is $10. This is the micro contract. With the full contract, without the M/GC, what would our move be? Each dollar move would be $100. So 1/10 of the movement on that, all right? Okay, let's look at some other examples. Let me go to that column on the left, and I'm just going to stick with micro futures here for a little bit because I want to show you an example of a couple others. And let me just think, for time's sake, let's try let's go short on one, okay? So I'm going to go to micro crude oil, okay? Let's just kind of compare, the micro crude oil, MCL. Now, we said the contract for gold, the micro contracts have the M. So if I go to just CL without the M, point value $1,000. Let's go to MCL /MCL, $100. So 1/10 of the value. So why would one take more of a bearish stance than a bullish stance? Because look, crude oil can go up in price for a lot of reasons. Generally, we talk about supply issues and demand issues, which is controlling the price of oil. But think about the world with oil. When there's say a geopolitical crisis, okay, let's say, heaven forbid, the war breaks out in the Middle East and Iran gets involved and the Strait of Hormuz gets closed or something like that. What's going to happen to the price of oil? Well, before we get to the price of oil, what's going to happen to the price of the market? It's very likely in a situation like that, the price of the market will go down. Oil tends to go opposite that in the case of that. Oil would probably spike up pretty significantly. And that, for all I know, that could happen. I'm no geopolitical expert or anything. I don't know what's going to happen in the future. None of us knows. So there's unexpected that happens. But that's kind of a difference between oil and a lot of things. Oil often will spike when bad stuff happens sometimes. In this case, oil's been going down though. So from the technical trader, for the trader who is taking a more of a bearish stance saying, hey, we're below our 20-day moving average, which is the red line. We're below our 50-day moving average, which is the blue line. It kind of looks like we're kind of doing this kind of flaggy thing when maybe we think it's going to continue to go down. Okay. So in this case, what am I going to do is I'm going to look to go short. This is just an example trade here. Okay, this is just an example trade. We're going to look to go short on that. So I'm going to go short the oil, the micro oil contract. But remember, we want to get a sense, number one, for the liquidity, and then number two, what kind of move are we talking about here on this? So liquidity, I'm going to go to that trade tab. I'm going to look here and 27,000 shares, and even the next contract out is 5,600 shares. And one question that comes up is, hey, look, if I buy these contracts, am I going to end up, or let's say I buy wheat contracts or something, or buy oil contracts, am I going to end up with bushels of wheat on my doorstep or barrels of oil on my doorstep? The answer is no, you're not. First of all, because you're going to start out trading paper money. But secondly, Schwab does not facilitate the transfer of the actual product there on those, okay? So you don't have to worry about that. But you do have the financial obligation, okay? Now, if I'm going short on this and I'm expecting this to go down, could I put a stop on it? Yeah, the stop would be above the current price. If I say $60 is kind of, we bounced off this, we kind of hesitated there, I'm going to go and put a stop up, well, maybe near my 20-day moving average, around $62. Let me just jot that down again so I don't forget. $62 stop. If I am selling to go, so I'm selling to enter. Sell to enter. How do I get out? Well, I'm going to buy to exit. Okay, and this is a stop order. So this is going to be a buy stop at $62 in that case. So that's my trade. Now, can I also set a target price? I can also set a target price. So if I think this is likely to go down by basically the magnitude of the last move we had on this. In other words, you know, we went like this and this, but most recently we went here to here. I'm going to call that before we kind of went sideways a little bit. I'm going to take the length of this, which was right around 63 down to about 58, about a little less than that. So we're going to say 63 to 58 would be $5. We'll say a $4.50 move. Okay. So I'm going to take a $4.50 move here. How do I get a $4.50 move? Well, if the current price is 58.26 minus 4.5, I'm coming up with 53.76 is going to be my target price on this. 53.76. So that puts it right around here roughly. Okay, roughly around there. That's my target price. That's going to be a limit. My stop, which isn't guaranteed to fill at that price, or remember our discussion on protection points, it's not guaranteed to fill at all. Our stop was going to be up here around 62, roughly in that area. How do we do that trade? Well, here's how you do it. I'm going to right-click on this. I'm going to sell custom with an OCO bracket. I'm entering the trade short. I have a limit price, which is going to be the target price. We said the target was going to be 53.76. 53.76. It's going to be good till canceled. My stop price is going to be good till canceled as well. My stop price right here is going to be, I wrote it down, $62. Sorry, I unlocked that and it changed. $62 on the stop, 53.76.76 on the target. There we go. Okay. Now, consider this. When we look at this, if we enter for about this price, we're short. So we benefit if it goes down. The limit price is the target price. We want it to do that. We want it to go down there. And then we can figure out how much we'd potentially make. Remember, we'd take the point value, $100 right there, and multiply that by the difference in the point value of our entry price and our limit price there. And so that's remember, and this price is lower than this because we benefit if the stock goes down, or not the stock, if the futures contract goes down. If the futures contract goes up, that's a bad scenario because we're short. And if we were to get out at the stop price, which is a big if, we already talked about that, it's roughly a $4 difference there on that, which would be about a $400 loss if we were to get out at that stop price there. Okay. There we go. So let's just review it. And that's why we review. I caught myself a minute ago because I was able to review it and realized I had messed that up. And that's this. And I'm just going to adjust this down just a few pennies just to try and get the fill on that. And I'm going to send that order. And that is a short contract. We're now short. We want oil to continue to go down here. That is what that price is doing there, okay? That's what our goal is there. Now, can you set a trade to execute when the stock goes below a moving average? What you can do is you can when you're doing a trade, and we'll probably finish up with this. Let's say I'm doing a trade and I want to put a price to execute. What I can do is I can go here and I can click on the gear and I can say, I want this futures contract to trade if it goes below a moving average or something. It's a little bit more complicated here to do that, but I can go here, I can go to my study, I can edit that, and what I can do is I can add a condition, and I can say if the price crosses below a study, which is a moving average. You can do a simple moving average there and do it that way. So it's a little bit beyond the scope of what we're doing today, but technically the answer is yes. Practically, it's a little bit more complicated there. So that's how you can do that there. Okay. Now, talk about reward to risk on the trade. Remember, we got in at 58.14 on this trade. 58.14. What's our reward to risk? Remember, the reward to risk is, it's kind of, we're assuming if we calculate this reward to risk that we're getting out at that, it's not going to let me use my drawing tool while I have that up, but when we calculate a reward risk, that's making a big assumption that we're actually getting out at that stop level, right? Okay, on there. But if I take the entry price, 58.14, 58.14, subtract this is our target price, 53.71, I come up with 443. 443 would be the reward part of that equation. If I take the stop price, assuming we get out the stop, 61.95, subtract the entry price of 58.14, I come up with 381. 381. That's the risk. So if my reward is 4.43, the risk of 3.81, you would just divide one by the other to come up with that. Okay? So that's how you do that. All right? I'm hoping that helps. So now, I'm out of time. Let me just mention what we went through. We talked about just basics of futures trading. Start with your paper money account, right? There's other risks with futures. There's more leverage. Remember, we have those protection points, which means that stops, it's just not a matter of the stop not getting filled at a certain price that we expect. It means it could not get filled at all on that. So we showed you how to calculate rewards or potential gains or potential losses using the multiplier, what the tick values were on that, and the minimum tick sizes. We talked about that. We talked about how to access different lists of futures. And there you go, everybody. Thanks for joining me today. I appreciate you. Coming up at 11 o'clock Eastern Time, we have the Investing Master Series. Make sure you follow Barb and myself on X, at Brent Moore CS, at Barb Armstrong CS. Barb, thank you for helping out in the chat. Make sure you subscribe on that Trader Talks channel. And everybody, have a wonderful, wonderful day. Bye-bye, everybody.